Tuesday on Squawk. Welcome back. We're back live with Kei Okamura staying with us from up in Tokyo. He's with Neuberger Berman, and we left off, Kei, talking about whether or not the price action we saw reflects official intervention, even though there's been nothing acknowledged by either MOF or the BOJ. What do you think?
That's right. So in the last sort of 12 hours, we've seen quite a momentous move in the end. I would say that the likelihood is that the government has acted, especially considering the way the yen has moved. Keep in mind, though, that in the past 3-4 rounds, the government has said once before that it has acted, but ever since it says that basically no comment. So it's hard to say, but given the likely moves that we've seen in the end, yes.
So then the question becomes, right? Is it just a one-off, or is this the start of a campaign of action designed to lift the yen?
Sure. At the end of the day, I think it's important for the government to send a strong message out to the market that, there are certain lines in the sand that cannot be crossed. Clearly, if this is the case of the intervention, 160 is one to think about. That said, it's going to be very difficult going forward, especially given that we have the FOMC meeting this week, a slew of U.S. economic data. And the reason why I'm emphasizing on this point is because the recent moves in the yen have really been a result of what's been happening on stateside as opposed to what's been happening in Japan.
So let's connect the dots here with what's going on in the U.S. On the surface, a lot of folks are saying, look, yen is basically just not going to budge. It's not going to move north really sustainably until only if and when the Fed starts to cut rates. Is it really just that, or is, as one of my colleagues was pointing out earlier this morning, what happens at the short end of the U.S. yield curve with record issuance, whether the indirect bid is there or not?
Of course. Look, the point that you raised about the yield curve, I also see your point there, and I think it's important to sort of split this into 2 points. Number one, the short term. Number two, the mid to long term. The latter is what we're more interested about as long-term investors in Japan, bottom up as well. In the short term, we have this situation where the direction of the U.S. dollar is very uncertain given what's been happening with market participants pushing back the schedule for future rate cuts, going forward. On the other hand, in the mid to long term, our view continues to remain that we do expect that as the wage numbers in Japan continue to pick up, and especially in terms of wage growth, and then of course going forward, as that sort of filters through to the rest of the economy, we should expect to see consumption starting to pick up, especially in the summer. So June, July, August going forward, then that would give enough data evidence, which Governor Ueda of the Bank of Japan has continued to seek for, give enough evidence for the central bank to move again, this time to further raise interest rates going forward, and that we think will finally bring the yen back, the ball back to the Japanese court in terms of future moves in the yen going forward.